Hi guys, in this video I'm going to cover the content of BTEC Level 3, Unit 3, the sources of finance, which is part of business finance. What is sources of finance? The source of finance is where the money comes from. So what the money is used for will help determine which source of finance is the most suitable. Sources of finance can be long-term or short-term, and they can be internal, so that's money that's available from within the business, or external, which is finance available from outside the business. The types of internal sources of finance are retained profit, net current assets, and sale of assets. What is retained profit? Retained profit is the money that's kept in the business to fund expenditure, and that's calculated by doing sales revenue minus the total cost. The benefits of retained profit is that no interest is charged, it's available immediately, and there is no loss of ownership. However, the limitations are that the amount available might be limited. What are net current assets? Net current assets show the money that is available in the business to fund day-to-day expenditure, and that's calculated by doing the current assets minus the current liabilities. The benefits of net current assets are that it encourages the business to manage their cash flow. However, if the firm does have low stock, then they're going to find it difficult to meet their customer needs. What is sale of assets? Sale of assets is when a business sells an asset that they own in order to get immediate cash back. It reduces any tied up money that the business might have. However, the amount that they receive might not reflect the actual value of the asset, and if the asset needs to be leased back, then that can cause extra cost in the future. What are the types of external sources of finance? There are owner's capital, loans, crowdfunding, mortgages, venture capital, debt factoring, hire purchase, leasing, trade credit, grants, donations, peer-to-peer lending, and invoice discounting. What is owner's capital? Owner's capital is money that the owner invests into the business from their own personal savings. The benefits are that no interest payments, and you don't need to repay the money. However, the amount available can be limited. What are loans? Loans is money that a business will borrow from a financial institution for a set period of time. There will be pre-agreed payments, so that means that budgeting will be easier. However, interest is charged and the loan can be secured against an asset. What is crowdfunding? Crowdfunding involves attracting investment from numbers of investors that will then invest small amounts of money into the business. And if that matches the amount of money that the business needs, then the investments will be collected. The benefits of crowdfunding is that there is no interest charged. However, the limitations of crowdfunding is that the business will lose some of their ownership. What are mortgages? Mortgages are long-term loans and normally around 25 years, and they will be used for the purchase of a specific asset. The benefits of a mortgage is that a large amount of finance can be raised to pay the loan over a long period of time. However, interest is charged, the mortgage will be secured against an asset, and it is not so suitable for any short-term finance. What is venture capital? Venture capital is when an experienced entrepreneur will invest into the business in return for a stake in the business. The benefits of venture capital is that the finance is provided by a professional and they can give the business guidance. However, again, the limitation of a venture capital would be that the business are going to lose part of their ownership. What is debt factoring? Debt factoring is when the business will sell their debts to a third party in order to get cash quickly. The third party will then pay the business the percentage of the money, and then they will chase up the debts. The benefits of debt factoring is that it speeds up the cash flow in the business. However, the limitation is that the business is only going to receive a percentage of the money owed. What is hire purchase? Hire purchase is the business will pay to use an asset and they will spread the cost over its useful life. The asset will remain in the property of the seller until the loan has been paid off. The benefits of hire purchase is that there will be regular installments, which makes budgeting easier, and it will spread the cost over a long period of time. However, the limitations of hire purchase is that it's only suitable for assets that have low cost, for example, a vehicle. What is leasing? Leasing is the business will pay to use an asset and they're going to spread the cost over its useful life. The asset will remain in the property of the seller until the loan has been paid off. The benefits of leasing is that if there is any repairs to be made, it will be the responsibility of the supplier to make those repairs, and it will spread the cost over a long period of time. However, the limitations of leasing is that the asset will never be owned by the business. What is trade credit? Trade credit, this is a period of time that the business will give the customers to purchase a good or service, and then they can pay later on an agreed date. The benefits of trade credit is that it helps cash flow and there's no loss of ownership. However, it's only suitable for short-term finance. What are grants? That is a lump sum that's provided to a business by the government or another organization to be used for a specific purpose. The benefits are there's no need to repay and there is no interest charged. However, there is a lengthy application process for a grant. What are donations? These are sums of money that are given to a charity. Benefits, there is no interest charged. However, the limitations is that there will only be small amounts available. What is peer-to-peer lending? This is when one business will lend money to another business in return for interest payments. The benefits of that is that there's a fixed rates of interest can be agreed, which makes it easier to budget. However, the limitations is that the amount of money available might be limited. What is invoice discounting? Invoice discounting is reductions that are offered to customers that will make the product or service easier. Benefits are that there's no interest charged and there's no loss of ownership. However, the limitations is that it might only be available if the purchase is made in cash. Here are some practice questions for you to practice. Have a go at them. You can pause the video and have a go at them. If you like this video, then give it a like. If you'd like to see more videos like this, then subscribe to my channel. You can also follow my Instagram for any updates on new videos or resources. And if you would like resources to this video, then you can go to my test shop.